Ladies and gentlemen, I'm changing my entire gold and silver price prediction for September 2025. And the reason I'm doing this isn't because of a sudden whim, but because the underlying forces that drive these markets have shifted in ways that demand a new perspective. The world economy is not a static system. It's a living, breathing organism where cycles, debts, policies, and psychology intersect to determine outcomes. And when the data changes, the probabilities change. Over the past several months, I've been closely examining three core drivers: the global monetary policy shift, the evolving debt dynamics in the United States and abroad, and the growing geopolitical risks. These three forces are converging in a way that makes me reconsider my earlier expectations about precious metals. When I talk about shifting my outlook on gold and silver, it's not about a simple change of opinion. It's about recognizing when the fundamental realities of the system have moved. Too often people anchor themselves to a forecast or a belief and refuse to let go even when the data is screaming otherwise. That's not how you survive as an investor. You have to constantly reassess, constantly weigh the probabilities, and constantly be willing to abandon an old view when the drivers that supported it have changed. What I've seen happening in the global economy, particularly over the past several months, forces me to rethink my entire prediction for where gold and silver will stand in September 2025. The first and most important thing to understand is that markets don't move randomly. They respond to cause and effect relationships that have been repeating themselves for centuries. Debt cycles, monetary policy, geopolitical shifts, technological developments. All of these are drivers that, in different combinations, determine where asset prices go. When I look at gold and silver today, the forces lining up behind them are much stronger than what I had initially projected. At first, I expected a gradual climb, steady but not dramatic. That view made sense based on the pace of inflation cooling, central banks attempting to stabilize policy, and the expectation that debt stress would be a slower burn. But reality has proven otherwise. The pace of change has accelerated. Inflation, while appearing to cool on the surface, is structurally embedded in ways that central banks can't easily tame. Wages, energy, and supply chain pressures remain elevated. Meanwhile, governments are still spending far beyond their means, adding new layers of deficit at a time when the cost of borrowing is already historically high. When you put those pieces together, you realize that the system is moving toward a breaking point faster than anticipated. That is why my outlook can't remain what it was 6 months ago. Now, with this shift, gold and silver become not just hedges, but essential recalibrations of value. When the currency in which everything is measured is being eroded, the things that hold intrinsic value rise, not because they've changed, but because the measuring stick has weakened. I often think of it like a scale. On one side, you have fiat currencies constantly losing weight as governments create more of them. On the other side, you have gold and silver, which are fixed in their supply and immune to political manipulation. As the scale tips, the price measured in dollars, euros, or yen rises. This is why I can no longer hold onto the view that we're going to see a modest and gradual climb into September. The conditions suggest something sharper, something more forceful. The market is beginning to price in that reality, and the repricing may happen much faster than most anticipate. Silver, especially, which tends to move with greater volatility, has the potential to deliver outsized gains once momentum builds. Changing an outlook is not about being wrong before, it's about being adaptive now. If you're navigating in a storm and the winds shift, you adjust your sails. If you keep going in the same direction out of stubbornness, you don't survive. The winds have shifted and the data is clear. Gold and silver are about to be repriced upward as the global economy wrestles with inflation that isn't truly under control, debts that are spiraling, and geopolitical fault lines that are widening. So when I say I'm changing my prediction for September 2025, it's not a casual statement. It's a recognition that the world has moved to a different stage of the cycle. Those who remain locked into old expectations will be caught off guard. Those who adapt will be prepared, and in this environment, preparation means treating precious metals not as speculative side bets, but as central, core assets in the portfolio. That is the reality of the shift we're living through. When we look at monetary policy today, it's clear we've reached a critical turning point. Central banks around the world, especially the Federal Reserve, are caught in a dilemma they cannot easily resolve. Inflation is still too high to ignore, yet the economy is slowing in ways that make further tightening dangerous. This tension is the essence of where we stand. On one hand, raising rates further could suffocate growth, push unemployment higher, and trigger a deeper recession. On the other hand, easing too early or too aggressively risks letting inflation run hotter again. Either path leads to instability, and instability is the environment where gold and silver thrive. The truth is, policymakers are biased toward choosing the path of least pain in the short term. That's the reality of democracies and governments managing massive debt loads. They prefer to create money and suppress yields rather than allow the full deflationary consequences of austerity. History has shown this pattern repeatedly. When countries are overburdened with debt, they don't pay it back in real terms. They debase the currency. That is the hidden tax that most people don't understand until it's too late. And that is the environment we are entering as September 2025 approaches. Gold and silver respond directly to this debasement. They are not promises to pay. They are assets without liability. When a government prints money, it cannot print gold. When a central bank lowers interest rates below the inflation rate, it guarantees negative real returns on cash and bonds. At that moment, gold and silver become not just alternatives, but superior stores of wealth. This is why the dilemma central banks face is not just an economic challenge. It's a catalyst for revaluing precious metals. Think about what's happening to debt servicing costs in the United States. Interest payments are now one of the largest line items in the federal budget. The government is essentially borrowing to pay interest on its borrowing, and the cycle compounds. To finance this, more bonds must be issued, but who will buy them at yields that don't compensate for inflation risk? Foreign central banks are reducing their treasury holdings. Domestic investors are wary. That leaves the central bank as the buyer of last resort. And when central banks buy government debt, they do so by creating money. This is quantitative easing by another name, and it weakens the currency while strengthening the case for gold and silver. What I underestimated in my earlier view was the speed at which this dynamic would force itself into the open. I thought central banks might have more room to maneuver, more time to walk a fine line between fighting inflation and sustaining growth. But the debt dynamics are squeezing them faster. Inflation isn't falling back to 2% without inflicting pain that policymakers have no appetite to impose. That means the printing press will come back online sooner than expected, and markets will see through that. This is the reason why my outlook for precious metals has shifted from gradual gains to something sharper. Monetary policy is no longer about fine-tuning, it's about survival. When a system is cornered, it chooses the path that buys time, even if that time comes at the expense of long-term stability. That is precisely what is happening now, and gold and silver are the natural beneficiaries of that choice. In September 2025, I expect markets to fully grasp that central banks are trapped. They cannot restore stability without debasing money, and that realization will drive demand for assets that stand outside the system. Gold and silver are at the top of that list. Investors who understand this will be positioned well. Those who don't will watch their purchasing power erode while clinging to assets tied to promises that can't be kept. When we turn to the debt dynamics, it's important to understand that what's happening right now is not business as usual. It's the late stage of a long-term debt cycle. Short-term cycles come and go with recessions and recoveries, but the big debt cycles take decades to build, and when they peak, they force a restructuring of the system. What I see happening in the United States and much of the developed world is the acceleration of this late-stage debt cycle. The costs of maintaining these debts are becoming unmanageable, and the options available to governments are narrowing. That reality is central to why my outlook on gold and silver has shifted so significantly. The U.S. government, for example, is running deficits at a pace that would normally be expected only during wartime or deep recession. Yet we're not in either of those conditions formally. This shows you how extraordinary the fiscal imbalance has become. And layered on top of those deficits are interest payments that are spiraling upward because of higher rates. When a government pays more in interest on its debt than it does for critical programs, it enters a trap. That trap forces choices: either raise taxes, cut spending, or issue even more debt. Raising taxes aggressively can weaken growth. Cutting spending is politically impossible at the scale required. That leaves issuing more debt as the path of least resistance. But who is going to buy that debt? Historically, foreign investors and central banks have played a major role in financing U.S. deficits. Today, that demand is weakening. Countries are diversifying their reserves, buying fewer treasuries, and in many cases, turning toward gold as an alternative. Domestically, investors see the risk of inflation eroding returns, and they demand higher yields. Higher yields mean even higher interest costs, and the cycle tightens further. This is the self-reinforcing spiral that defines a late-stage debt cycle. Now, what happens in this environment is predictable if you study history. Central banks eventually step in to fill the gap, becoming the buyer of last resort. They purchase government debt not because it makes economic sense, but because the system cannot function otherwise. And they do this with money creation. That process effectively transfers the burden of debt onto the currency itself. It is a hidden form of default. Rather than refusing to pay creditors, governments pay them back in money that is worth less. This is why gold and silver matter so much right now. They cannot be debased by policy decisions. They exist outside the credit system. In my earlier forecast, I believed this stage would unfold more gradually, that governments would have more time before debt servicing costs truly became unsustainable. But in the last year, the math has moved much faster. Interest costs are already competing with major spending categories. Deficits are not shrinking, they are widening, and political gridlock makes any meaningful fiscal reform impossible. That means we are much closer to the tipping point than I initially thought. For gold and silver, this is not just a supportive backdrop, it is a catalyst. When investors realize that bonds are no longer safe, that cash yields are negative after inflation, and that the only way governments can sustain their obligations is by printing more money. They reprice their portfolios. They move toward real assets. They move toward scarcity. Gold and silver become not speculative trades but necessary stores of wealth. Silver, because of its smaller market and dual role in industry, often outpaces gold once the momentum shifts. That's why I now see not just steady gains, but the potential for a breakout. The core lesson is that debt cycles always end the same way, with restructuring. Restructuring can take the form of defaults, austerity, or devaluation. In our current system, devaluation through money creation is the path being chosen. That reality is already visible in the numbers, and markets will recognize it more fully by September 2025. So when I adjust my outlook, it's because the debt crisis isn't a slow, moving cloud on the horizon anymore. It's the storm directly overhead. And in storms like this, gold and silver don't just perform well, they become lifeboats. Anyone ignoring that dynamic is failing to learn from history. Those who prepare will understand that precious metals are not optional. They are essential in protecting wealth when the credit system is stretched to its breaking point. When I look at the geopolitical environment today, I see fault lines widening in ways that make the global economy far more fragile than many realize. Geopolitics is not a side story. It's a central driver of markets, currencies, and asset values. History shows us that when nations cooperate, trade flows freely, and trust is strong, capital moves easily across borders, reserves are concentrated in dominant currencies, and stability holds. But when that cooperation breaks down, when tensions escalate, and when trust erodes, money moves differently. It seeks safety outside of political promises. That's why in times of fragmentation, gold always rises in importance. And that's why my outlook on precious metals for September 2025 has shifted to reflect these geopolitical realities. What we're seeing right now is a world breaking into blocks, the era of globalization as we knew it, where supply chains stretched across continents, where the U.S. dollar was the unquestioned reserve currency, and where nations largely trusted one another to keep trade and capital flowing, is eroding. Instead, there's a movement toward regionalization, self-reliance, and hedging against dependency. The U.S.-China relationship is the most obvious example. Trade disputes, technological restrictions, and military posturing are pushing both sides to reduce exposure to the other. But it's not just the U.S. and China. Across Europe, the Middle East, Asia, and Latin America, countries are reevaluating alliances and building new arrangements that weaken the idea of a unified global system. In practical terms, this creates two direct consequences for markets. First, it makes supply chains less efficient, which drives costs higher and keeps inflation more persistent. Second, it undermines trust in the U.S. dollar as the singular global reserve currency. When countries feel vulnerable to sanctions, restrictions, or financial pressure tied to their dollar holdings, they begin to diversify, and diversification means buying gold. Central banks around the world are already accelerating their gold purchases at the fastest pace in decades. That's not a coincidence. It's a hedge against fragmentation and mistrust. Silver also benefits in this environment, though for different reasons. While gold is a monetary asset, silver straddles both worlds. It is a store of value, but also a critical industrial metal. As nations compete to dominate advanced technologies, renewable energy, and infrastructure, silver demand rises. Solar panels, electronics, and new energy grids all require silver. So while gold reflects the geopolitical distrust of paper currencies, silver reflects both that and the industrial arms race underway. That dual demand is why silver can often outperform gold percentage-wise in volatile periods. In my earlier view, I expected geopolitics to remain a background risk, something that simmered but didn't explode into a major driver in the near term. But over the past year, it's clear that the fragmentation process is moving faster. The U.S. is weaponizing its financial system through sanctions, tariffs, and export controls. China and other nations are responding by building alternative systems, whether it's in payments, currency swaps, or strategic resource hoarding. Conflicts in regions like Eastern Europe and the South China Sea add layers of uncertainty. These are not isolated incidents. They are signals of a world reordering itself. When trust erodes at the global level, investors and governments alike turn to assets that aren't tied to any one nation's political decisions. That is the role gold has always played. In past periods of fragmentation, whether it was during the Cold War, the World Wars, or the breakdown of monetary agreements like Bretton Woods, gold surged because it was the neutral asset. We are entering a similar period now, and it is happening more quickly than expected. By September 2025, I believe this trend will be undeniable. Central banks will continue building reserves in gold as a shield against geopolitical shocks. Investors will increasingly view gold and silver as protection not just from inflation, but from instability in the world order. And markets will begin repricing these metals accordingly. What looked like modest insurance before will be seen as an essential hedge. This is why I'm changing my prediction. I underestimated how fast the erosion of trust would translate into real market behavior. I expected gradual diversification, but what I see now is acceleration. The very foundations of the global financial system, the assumption that the U.S. dollar can remain unquestioned, that alliances are stable, and that globalization will keep efficiency higher cracking. In that environment, the revaluation of precious metals is not just possible, it's inevitable. When you study history, you see this pattern clearly. Every time the global order shifts, financial assets tied to governments lose credibility, and gold and silver gain it. We are living through one of those shifts now. The only uncertainty is how quickly markets will wake up to it. And given the pace of change, I believe that awakening will be visible by September 2025. For those who are paying attention, the lesson is clear. Gold and silver are not only hedges against inflation or currency debasement. They are hedges against a breakdown in global trust. And in a world moving toward fragmentation, they become central, not peripheral, assets in any portfolio. Those who grasp this reality will be positioned to weather what comes next. Those who don't will find themselves exposed to risks they never considered. When I say that gold and silver are positioned for a breakout rather than modest gains, I'm not making that statement lightly. Breakouts in markets don't happen in isolation. They occur when a set of conditions converge, creating a tipping point where prices can no longer remain contained. We are entering that kind of environment now, and that is why I've changed my prediction for September 2025. The drivers we've discussed, monetary policy constraints, unsustainable debt dynamics, and escalating geopolitical fragmentation, all come together to form a backdrop where precious metals are no longer just alternative investments. They are essential safe havens. And when safe havens move from the periphery to the center of global demand, repricing doesn't happen gradually. It happens sharply. Let's start with the psychology of markets. For years, gold and silver have been treated as hedges. things you add to your portfolio to protect against inflation or crisis, but not assets to overweight. Most investors see them as static insurance rather than dynamic opportunities. But when confidence in currencies and financial systems begins to break down, the psychology flips. Investors stop asking, "Should I own some gold?" and begin asking, "How much gold is enough?" That shift in psychology is powerful because it creates sudden surges of demand. And unlike financial assets, gold and silver supply cannot be expanded to meet that demand quickly. The supply is relatively fixed, which means price has to adjust sharply to clear the market. Gold, because of its monetary role, becomes the first destination for this demand. Central banks, sovereign wealth funds, and long-term investors all seek it as a hedge against systemic risk. Silver, on the other hand, behaves more like a high-beta version of gold. It's smaller in market size, more volatile, and more influenced by industrial demand. But when the monetary premium rises, silver's moves can dwarf those of gold. This dual nature is what makes silver especially interesting in the current environment. It has the foundation of industrial demand tied to renewable energy and technology, and the tailwind of monetary demand tied to distrust in fiat currencies. That combination creates the potential for outsized returns once momentum builds. Now, when we look at September 2025, why do I see this as a breakout point rather than just another step upward? Because the confluence of forces is reaching maturity. Central banks will be visibly trapped by then. They won't be able to lower inflation without wrecking growth, and they won't be able to sustain growth without reigniting inflation. Debt servicing costs will be straining budgets to the point where fiscal debates become crises. And geopolitical tensions will be so entrenched that diversification away from the dollar will no longer be speculation but standard practice. When all three of these align, investors will have no choice but to reprice gold and silver upward. Breakouts also tend to happen when markets are caught off guard. Right now, many investors are still anchored to the belief that inflation will normalize, that deficits can be managed, and that the dollar will remain unchallenged. They're underweight precious metals, assuming they'll only perform modestly. When that belief is shattered, when inflation proves stickier, deficits prove larger, and the dollar proves weaker, money will rush into metals in a way that creates not linear but exponential moves. That's the nature of a breakout. It's not just higher prices. It's a psychological reset of what those assets are worth in a changed world. History provides ample evidence of this pattern. During the 1970s, when inflation and geopolitical risks converged, gold didn't just drift higher, it surged dramatically in a matter of years. Silver followed with even larger percentage gains. The same dynamic appeared during the global financial crisis of 2008-2011, when trust in the system broke down. Each time, the drivers were slightly different, but the underlying principle was the same. When the system itself is in question, gold and silver get repriced higher, quickly and forcefully. That's the stage we're entering. And this is why I can't hold onto a modest prediction anymore. By September 2025, I expect not just incremental gains, but the conditions for a breakout. That doesn't mean a straight line upward. There will be volatility, corrections, and noise along the way. But the direction is unmistakable. Precious metals are being revalued, and the market is underestimating the speed and scale of that process. For investors, this means rethinking their positioning. Precious metals should not be treated as a minor allocation or a hedge at the edges of the portfolio. They should be viewed as core holdings in an environment where the traditional pillars of safety, government bonds and reserve currencies, are no longer reliable. Those who wait until the breakout is obvious will pay far higher prices to secure their exposure. Those who understand the shift now will be prepared. The breakout I see is not just about price, it's about recognition. Recognition that the world has changed, that the old rules no longer apply, and that in times of debt, debasement, and distrust, the only assets that stand outside the system are the ones that endure. Gold and silver are those assets. And by September 2025, I believe the market will recognize that in a way it hasn't in decades. The reality we face is that the global economy has entered a new stage of the cycle, one defined by high debt burdens, trapped central banks, and deepening geopolitical fragmentation. These forces are converging faster than most expected, and they are setting the stage for a sharp repricing of gold and silver. What was once considered a hedge on the periphery is becoming a necessity at the center of sound portfolios. By September 2025, I believe the world will begin to recognize that currencies are being debased, debt is unsustainable, and trust in the existing order is eroding. In that environment, gold and silver are not optional. They are essential stores of value that will define how wealth is preserved through the storm ahead.